This is InvestTalk. Independent thinking, shared success.
Hi, my name is Sabrina, and I am just looking for some information on ticker MSTY. Is an ETF and also pays a dividend. I am just looking to see if I should be purchasing this or not. Look forward to hearing the answer. Thank you.
All right. This is a great one. This is if I remember correctly, MSTY. There we go. So this is the MicroStrategy income strategy ETF. So it's a covered call strategy just simply on MicroStrategy, the stock. Okay. And it's interesting. And you're going to look at the yield that it is going to spit out at you. And it's going to look very high. Right now, it's 171%. That's what it says. Obviously, that's not factual, or at least it's not what you should expect going forward. Okay. So MicroStrategy has had a big run up as well as a big run down. And there's a lot of implied volatility here that they're selling, and then they're capturing a lot of that volatility, and they, but that can limit the upside. And so, this is part of a lot of these yield max ETFs that are out there, high fee, and it is a safer way, shall we say, to play these particular stocks. But it doesn't mean it's safe. It's still very, very volatile, just like the underlying stock. Now, obviously, this hasn't been around very long. So far this year, it's up 16% in just 2 weeks, but that's because MicroStrategy's up. But if this goes down, MicroStrategy goes from 366, 367 to close today, heads back down closer to 100. That covered call is not going to hedge you very much, right? So you're still taking a lot of risk. Now, could you argue it's a better way to play MicroStrategy? Yes, I could argue that. But it's still extremely, extremely high risk, and it's going to be highly levered to Bitcoin. Remember, MicroStrategy is buying Bitcoin. They're leveraging up their balance sheet. They're issuing convertible bonds. They're issuing, I believe, preferred shares, and they're using that to buy Bitcoin. And so if Bitcoin does fairly well, this is a leveraged bet on that, which means it's extremely high risk. So you're taking something that's extremely high risk into something that's modestly lower in risk, but still extremely high risk. Okay. And so it depends on the underlying. Are you bullish on the underlying? Then I'd probably just own the underlying, right? If you're willing to take that level of risk, why not take just a little more risk and just own the underlying, which is a highly levered bet on Bitcoin. But you have to remember, their balance sheet, it's the valuation on MicroStrategy is way higher now than the book value of what they own in Bitcoin. I don't remember the number. I haven't looked at the recent update, but it's something like 3 or 4 times the value of Bitcoin on their balance sheet. That's how much it's trading for. So I don't think it's going to stay this high. I wouldn't own either MicroStrategy or MSTY. Thanks for the call. Now, I hope you've been telling your friends and family about our InvestTalk podcast, which is available in video form over on our YouTube channel, and we get questions submitted via the comments section over there. So let's tackle one of those now. Jim says, what do you think of EPRT? Is a good long-term buy and hold? So EPRT is a REIT, and it acquires and manages primary single-tenant commercial properties. I like that. I like those type of properties. And if you look at the chart, it's an uptrend. It just pulled back to its 200-day moving average, but that frankly is fine. It needs a refresh on a weekly chart. It's still an uptrend, certainly outperforming a lot of the other REITs in the space. And this is a good example. The current yield is 3.7%. Not amazing. Remember, this is in a taxable account. It's taxed at your ordinary income tax rate. So that's one thing you have to understand about all REITs. Taxable account, your ordinary income tax rate. 3.7%, especially at the higher tax rate, isn't that amazing. But it's in an uptrend. A lot of people are going to be chasing the yields in the REIT space. They want 6, 7%. They think that's the way to invest in REITs. No, it's about the quality of the properties, the management, et cetera. And last quarter revenues are up 28%. So this is a type of name that I do really like in this space. There are other subsectors I like a bit better, but single tenant commercial properties meaning that you're typically standalone McDonald's and Starbucks and Burger Kings, right? Restaurants, things like that. Maybe banks, etc. Those are the type of properties that essential properties would typically own. And so in that case, I like it. I'm going to give this one a thumbs up. One of the better names within the REIT space. Thanks for the question. Let's go ahead and dip back into the InvestTalk voice bank. And you know the number. It's 888-99-CHART.
Hello, Justin and Luke. This is Miguel calling from Lake Forest, California. I actually have a question about a company called Carvana, ticker symbol CVNA. I don't own the company and I don't want to own it. I'm actually thinking about a strategy of buying puts for January 2026. And I'm looking at the strike price of 100. I would like to know your opinion on this trading strategy, since I consider Carvana very expensive and overvalued. I would like to know what your opinion is based on the technical and fundamentals of this company. I will listen on the podcast. Thank you. Bye.
All right. Well, I absolutely think the fundamentals are worth shorting. Carvana is a name that was losing a ton of money. It started to make money recently, but historically, it's not very well run. Even if they make their expected earnings for this year of $275, right now it's trading at $231 per share. So you're talking a forward-looking multiple close to 100, and they have a lot of debt on their balance sheet. It's a very difficult business for everyone else out there. Carvana is an e-commerce platform for buying and selling used cars, and they typically overpay for their cars, and they have historically good revenue growth, but they haven't really turned this into strong profitability. And this did recently, I think, top. And it moved from 267, recent low was around 176, is bouncing back, but right into resistance here around $235 per share. Close right now at 231.92. So after this bounce, I think this is a good place to enter a short. January of next year, I don't mind it. You're giving a good amount of time, and I think it easily could go to 100 or below. Now remember, you don't have to wait until it expires. Like if this just heads back towards 100, you could have some big gains here. So I like the idea of puts on Carvana. Thanks for the call.
Join our community of savvy investors. Subscribe to the KPP Premium newsletter for expert analysis and stock ideas.
Hello, Justin and Luke. I had a question on H&E Equipment Services. That's ticker symbol HEES. They're going to be bought out by URI, which is United Rentals. And I was thinking whether or not I should hold on to this stock. I'm thinking if I sell it now, it short-term gain. If I sell it in 3 months, it'd be a long-term gain, which is kind of what I was looking for. The alternative would be putting it into ticker symbol VO, which is the mid-cap. Thank you.
Well, I think you have the main point here is the taxes. Waiting 3 months to sell it, it probably won't close in 3 months. Let me see. I can't remember. So we own this. I own this. We sold it after it popped on the earnings, in the buyout news. Huge premium to where it closed just a few days ago, over 100%. And so there was only, I think we sold it. We sold it that day around in the 90s, and I think the buyout price is 92. So we didn't see much upside left, and we had only bought it a few months ago for clients, and so it wasn't really a long term consideration, because most likely this would be completed within those next 9 months. Now 3 months though, it's probably 3 to 6 months is where this will actually be completed. Let me see. Yeah, it's scheduled to finalize in the first quarter, actually. Yeah. So interesting. So yeah, there's a 35-day go shop period, which they could request other proposals. So they have about a month to figure that out. But this could close by the end of the first quarter. So, it's hard to say here, when exactly it will close. Remember, that's going to be a forced sale to you once it does close. And it might be within that 1 year mark, and you might not get that long term, but it might drag out a little longer before it closes, and you might get that long term. So kind of tough here. A lot depends on what your tax rate is, how much gains you actually have in this name. I'd probably wait a little bit because there's a decent chance this could drag out and get you to that full long-term capital gain number. Thanks for the call. Let's try another question from the InvestTalk YouTube channel. Iraq Don says, what do you think of Edward Life Sciences? EW seems to be doing things right, but maybe a little high. If you agree, what price would you start adding it? Low 60s is what I'm looking at. Okay, this is EW. It peaked out around $132 per share back in 2022. And there's been a downtrend ever since. And frankly, you zoom out to a weekly chart and had a big drop back in July from about 92 all the way down to a low around 60. It's bounced back a little bit, but still at $69. So like I said, in a long-term downtrend. And obviously, this is in the biotech space. And when you have this new administration coming in with RFK, who's looking to clamp down on a lot of what the pharma industry is doing, this is the type of company that could be in the crosshairs, and earnings expectations for next year for this year are down 5% from last year. So kind of no growth here, negative growth, trading at high 20s multiple. Forward-looking earnings, $244, roughly $70 per share. I just don't see the value here, and the trend in the stock and price is down. Right, relative strength is only 24. That's pretty bad. And let me look at their balance sheet. They have good balance sheet. That's a positive. But still, enterprise value to EBIT is around 22 and looks to be heading lower. And historically, it has traded lower than this. And so I just would not be jumping in front of this based on the trend in the stock, the political environment we are in, the trend in earnings. It's just not a name that jumps at me and says, you need to own this name. The only thing that's great about this is the profitability is very high. I do love that. But right now it's a bit higher than it is historically, which tends to be return equity in the low 20s. Now it's at 55. So I think it's over earning. Those earnings are coming down. Free cash flow yield is only about 1% here. So I would not own Edward Life Sciences. I think there's a lot more downside to come with the current trend. Thanks for the question. Now let's touch a bit on two of the major risks as we enter 2025. Now, corporate earnings generally are holding in there, most likely will hold in there for most of this year. But there are two big risks that have hit the market in the past and could threaten equity returns this year. Now, the first would be higher bond yields. And you saw this in 2022 when the 10-year went from sub 1% all the way to north of 5%. And that changed the market multiples that are out there, the cost of capital, and especially companies that didn't make money. I call it Ponzi capital, that before they were just issuing shares in order to finance their cash burn. That was no longer tenable for most companies. And so you saw that with like the Pelotons of the world that got crushed. And so valuations came in dramatically. And you saw the NASDAQ down 33%. And a lot of that, those valuations came in, and it was on the mega cap names that was driving down those major indices. And so this is an environment where if rates do continue to march higher like they have since September, this will weigh on those multiples. It will weigh on the market. And in a time of populist policies and a new consensus coming to the White House, you are likely to see higher inflation, higher interest rates, more protectionism, continued a strong fiscal impulse. And ultimately, that typically drives money towards harder assets and away from high multiple companies. Okay. So this is not a phenomenon that is just US based. It's really worldwide. And ultimately, the constraint on these populist policies that are happening now will be the willingness for the bond market to continue to accept it. And if they don't accept it, they don't accept the plan forward. This happened with Liz Truss back in the UK a few years ago. And she took office, had a big plan, and the bond market said, we're not buying that. We think it's a terrible idea. And rates skyrocketed, and she had to resign. And so at some point, there will be a politician in other countries, here in the United States, that will come in, and the market will have the conniption fit, right? They will send the message that the path forward is not tenable. And that is, with each passing year, no matter who's in office, it becomes a bigger risk. And that is storing up potential problems for equities at some point. Doesn't mean that's happened this year. Just understand that you want to keep an eye on things like the MOVE index, which is the volatility of the treasury market. You want to keep an eye on where treasury rates are. Is the 10-year breaking out? Where is inflation expectations? Are inflation expectations breaking out? And suddenly bonds become less attractive and bonds will be sold off. Okay. So an inflationary environment is typically bad for bonds. So if you see that impulse reemerge, that will be bad for equities. And so we're kind of entering the danger zone, kind of high fours, around 5% on the 10-year. If that gets 5.5%, 6%, that could be a big issue for equities. Now, the second big challenge will be the concentration in the major indices. We're very similar to 99-2000. Now, the difference, though, is that those companies that are concentrated, they typically have good businesses. And some of them are not very volatile. Apple's not very volatile. Meta, as long as they're not chasing stupid things like the metaverse, not that volatile. Amazon, not that volatile, but some are very volatile. NVIDIA historically has profitability, it's very volatile. Google can be volatile because it's tied to ads. Tesla, obviously, very volatile. So many of the mega cap names, you can't really lump them all together. They have their own idiosyncrasies, their own individual company risks. And so if one, think of what happened with Meta, right? That huge drawdown because they were throwing their traditional business out the window and basically focusing on Meta and using all their cash flows to invest in the metaverse. And the market said, once again, we're not buying that. We don't think that's a good use of capital. And the stock was driven down dramatically. And that certainly weighed on the indices as well. So, the dynamics of each Mag 7 company vary, and you have to treat them differently, and they have different business drivers. However, if 1, 2, 3 really struggle to maintain earnings growth, the growth stagnates, maybe they misallocate capital in some way, shape, or form, that could certainly weigh on the broader indices. So I think those are the two major risks that we see heading into 2025 for the broader market as a whole.
Hey, Justin. This is John Parker. I've been a longtime listener of your show, and I just have a brokerage portfolio question. So I have SCHP as 14% of my portfolio, holding about 180 shares. Is that a good idea to have in a brokerage account, even if I do have to pay taxes on the dividend for it? I also hold SPLG as well, with about 80 shares, and that's 10% of my portfolio. Should I try and exit out of those two ETFs and only stick with equity stocks, or should I keep them or one of them and just let it keep adding as the year progresses? Thank you. Look forward to hearing my question on your show.
All right, now it looks like you're basically holding the Schwab US Dividend Equity ETF, SCHD, and then SPLG, which is basically Schwab's S&P 500 ETF. Remember, there are multiple S&P 500 ETFs. There's SPLG, there's SPY, there's VOO. So there's a lot of those out there that gain exposure to the S&P. Now, the S&P, obviously, you're going to be more allocated to those Mag 7, growthier names, and you're going to be really reliant on growth outperforming and those individual names doing well, as I just spoke about. The Schwab Dividend Equity ETF, that's more of a large cap value ETF, so you're leaning more on the value side. We like that. I'd much rather have allocation to that. Now, you're getting broad diversification on both, but different leaning on different style factors. So you're kind of bridging the gap here by owning the SPY or the S&P, which is growthier, and then the SCHD, which is more on the value side, but both large cap. So this goes back to how much do you have exposure to mid and small long term? Mid is typically the best risk versus reward in the market over extended periods, whereas small caps have higher volatility, but they have the best total return. So a lot depends on your risk tolerance level, and this goes back to, I can't really answer this until I do a portfolio review. What else are you holding? What are your broad goals? What's your risk tolerance level? Does this align with your risk tolerance level? Can you handle the level of volatility that is typical for these names over extended periods of time? That's a big question as well. Now, when it comes to individual stocks, how much research do you want to do? Can you do? Do you have the tools to do, both from data and research, but also your own ability to analyze that data and research to create an effective strategy? It's something we've been doing for 30 years plus, right? I've been doing for 20 years plus. And so, there's an experience level that's typically needed for that. Owning a broad-based ETF, that there's no real research, not a whole lot of research that needs to be done there because you have that diversity. So I frankly encourage you to do a portfolio review. We can kind of go over this and see where you're at and see if any changes need to be made. But if I was going to lean on one or I was going to sell one, it would definitely be that S&P 500 ETF. And if I was going to add to or hold one of those two, it would be the Schwab US Dividend Equity ETF. Solid choice over the S&P, but not perfect in its own right either, but could be part of a solid portfolio. Okay.
Thank you for watching.
If this video was helpful, please give it a thumbs up and subscribe to catch our upcoming videos. Let's go take a live call from Bill in Northern California looking at Star Bulk Carriers, SBLK, listing on AM 1220. Do you own it or looking to buy it?
Well, maybe looking to buy it, but not really. I'm just researching it.
Okay.
Get your opinion on it, and historical perspective on the stock and on the company, overall long term. And if I bought it, it would probably be as a trade, but that could take a year or two to pan out. So,
if you're just buying it based on a trade, that's going to be all about the chart, and the chart is terrible, right? We're down from about $27 back in May time period, early June, and now we're down to $14 and change at the close today, and it is in a very strong downtrend. Relative strength is only 8. Now, how did you come across this? Is it looking for the dividend yield of 17%?
No, not really, because that varies a lot in the shipping industry.
True.
That's kind of like a little sideline thing on it, because that's probably going to come down and vary quite a bit. Now, even as a trade, I wasn't talking in terms of buying it right now at this time, but I like to research things in advance. And then when the chart and the price gets to a lower point, it could be, months and months or a year from now. But just to know about the background of the company, how good of a business it is, how well run it is within its sector and everything.
Well, historically, its earnings are way up and down. They lost money in 2017. They made $1.11 in 2018. Then only made 17 cents in 2020. Then $6.82 in 2021. And now $1.84 in 2023. And then up to $2.71 full year last year. And supposed to be $2.91 this year. So you can see how volatile earnings tend to be. So you certainly want to avoid in that instance. And you're talking about a trade. And so, yes, you can ride this up on a big trade because, the earnings can inflect very positively and the market can rally dramatically, just like it did in 2020 when it kind of consolidated around the $6 range after a move up in May, June timeframe, and then broke out from $6 and went all the way up to $33 at the peak back in middle of 2022. So huge run potential there, but it's given a lot of that back. So could you find a time where do you have a chart formation that is very positive? Yeah, but not at this time. So something to keep on your watch list and look for a chart pattern that lines up. But I don't see that happening anytime soon.
I like to watch charts with a strong downtrend because eventually that levels out. And a lot of stocks don't spend a lot of time down on the bottom before they turn around. And when they do turn around, often that initial jump is your best possible gain if you're having it as a trade.
Yeah.
Bottom fishing, but you got to be careful with that.
Yeah, definitely have to be careful with bottom fishing. What I would say is don't want to say that it is trending sideways, right? Down and trending sideways, because that's actually bearish. That's what we call bear flag. What you want to see is some sort of MACD divergence, meaning it might make a new low, but the MACD does not make a new low. You might see a strong reversal on volume, or vice versa, where you see a big final down move on huge volume. That means all the weak hands are out and there's no one really left to sell. And that often can be a marker of a bottom as well. But I'm not seeing anything on that here. So I like what you're looking at for a potential trade, but not something that I would really get excited about, right? Potentially at some point, but probably not anytime soon. Thanks for the call. Well, I think that about does it for this episode of InvestTalk. Appreciate you all tuning in and liking and subscribing to our YouTube channel as well as our podcast. And you can get your podcast anytime at iTunes, Spotify, Google Play. Be sure to rate and review on iTunes as well. Remember, we can help you better understand your portfolio dynamics and your broader financial picture by heading over to investtalk.com and clicking on Portfolio Review. This is a free and confidential service. And if you haven't optimized your 401k potential, we can help you do that as well. Just start once again at investtalk.com. Independent thinking, shared success. It's InvestTalk. Good night.